Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Really excited for today's show. We've got none other than Neal Bawa on with us today. So, Neal, welcome to the show.
Thanks for having me on the show, Brian. Great to be here.
Yeah, good having you and appreciate you taking some time for us today. So, we're going to start just like we start everything else. Tell us a little bit about yourself and how you got into multifamily.
Well, I'm a recovering technologist, so computer science degree.
Hmm.
Background, ran a tech company in Silicon Valley for about 14 years,
Hmm.
earned the big fat tech salary, and
Yep.
because I was living in Taxifornia, was paying the big fat tax check.
Did you
And
just say
for
you said
a
California?
Taxifornia, that's right, that's
I've
right.
never heard that before, but I get it. So,
I
yeah.
know.
All right, got
Yeah.
it.
So
Awesome.
so you can imagine, right? So there were years when my tax bill was 52% of my gross
Mhm.
income.
Yeah.
Because you pay 39% federal and then you pay 13.6% California. And so real estate was a fantastic way to get that number down to a much lower number and do it legally. So did real estate for 10 years, then
Mhm.
sold the company in 2013, had a very large tax bill, bought
Mhm.
multifamily to get rid of that tax bill, and in the process found that this was actually potentially a good second career
Mhm.
and morphed into it over a year. So 2014, I went professional. And so
Mhm.
the last 10 years have been working with nerdy techie investors like me that like data science of real estate. Currently have about
Mhm.
1,300 accredited investors, and they've given us 425 million in equity for a portfolio that, at completion is about $1 billion. A
Mhm.
lot of them are in Silicon Valley, so engineers, software professionals, doctors, lawyers, very tied to data. And so we have
Mhm.
a very nerdy group of people that like to make, real estate investments.
Yeah. Well, I mean, you figured out a way to connect with them. So, I mean,
I
that works
did.
well.
I did. Yeah, completely accidental, by the way. The bottom line is that I did not have any intentions of creating a real estate business. I
Mhm.
always felt like it was a good dabbling thing. I have dozens of single family homes that I own as rentals, and it was always a dabbling thing. It was
Mhm.
until 2014, I wasn't thinking of it being a business. And ironically, I think that's why it turned into a really good business because in 2009, I started publishing data science on real estate. I was fascinated by the answer to a single question. Which market in the United States is best for real estate investment and why? And
Yeah.
then I added a second question, and how often does that change?
Mhm.
Right? So markets obviously change over time. Austin may have been the best market in the US to invest in
Mhm.
5 years ago. Today, some people consider it to be the worst,
Yeah.
probably for the same reason.
Right.
So, I became obsessed with that idea, started
Mhm.
to pull terabytes of data from public websites like BLS.gov, Zillow,
Mhm.
Trulia, Redfin, Realtor.com, put it into a statistical analysis software called R, and
Mhm.
basically query that software and try to find what we call in data science, we call them correlations. What is
Mhm.
the correlation between real estate profit and population growth? What about job growth? What about income growth? What about home price growth? What about crime? What about schools? Where is the
Mhm.
correlation the heaviest to
Mhm.
profits? And the answers were always very, very surprising. And so we
Mhm.
started publishing those in a meetup group in 2009, in
Mhm.
a Udemy course in 2010. By 2011, I was getting called to conferences. I was the techie nerd that had nothing to sell. So conferences around the US would call me. And so by 2014, when I actually had my first syndication, I already had a massive list of thousands of people. I'd never asked them for anything. I was just sending them my research every quarter, like a newsletter.
Mhm.
And it was the easiest raise ever.
Yeah, I can imagine. I mean, 5 years of providing value and unintentionally creating your investor list. That's amazing. I've never heard you talk about that before. So, I mean, I've heard you called the mad scientist of real estate before. First of all, do you like that moniker and how did you get it?
I do because, here's the thing. I'm Indian and so I'm conservative in my outer appearance, but I think that the
Mhm.
inside of my head is very mad scientist-like.
Mhm.
So there's continuously ideas, there's continuously thoughts. My brain runs at full speed and often gets up at 2 o'clock in the morning and then I have to work for 2 hours just to calm it down and,
Mhm.
assign tasks. So I have four assistants
Mhm.
because the output of work that I produce in a given day, even though I only work 8-hour days,
Mhm.
is massive.
Mhm.
And since ChatGPT came out, it's roughly tripled.
Hmm.
Still working 8-hour days, but now I have 3 times the output. And the big reason for that is I spend about 45 minutes a day talking with
Hmm.
ChatGPT or doing math with ChatGPT. And that
Hmm.
turns into dozens and dozens of projects because all
Hmm.
of those strings are monitored by people and those turn into projects with, tens or hundreds of action items. So as a result, I do think that the moniker, the mad scientist of multifamily, sticks. It makes sense because I'm rather bizarre in my thinking.
Yeah, makes sense. Makes sense. All right, got it. Yeah, I was wondering, I mean, I have a military background, and when you earn nicknames or call signs in the military, they're usually derogatory, so I was just wondering,
That's right.
yeah, is
This
that
one
something?
actually I was on stage when somebody introduced me, I think in 2011.
Hmm.
I was on stage at a large conference in Provo, Utah, and somebody introduced me that way. And then when I came down from stage, the people were chuckling and talking about it. And then the next day, I was on a podcast, or what used to be a podcast in 2011, and somebody called me by that again. And I was like, this sounds interesting. Let me adopt it.
Yeah, awesome. And incidentally, Provo, Utah is really close I'm from Salt Lake, just north of Provo. Live in Idaho Falls right now, and I know I'm actually a couple of blocks from what somebody has pointed out as one of your investments.
One of my townhome projects. It
Yeah.
was the beta or alpha of
Mhm.
what is now Mission 10K. So we're building 10,000 townhomes. We've received more than $100 million in investment in the first quarter of this year.
Mhm.
And all of it was based on a single project, which is 5 minutes or 10 minutes from where you live in
Yeah.
Idaho Falls. So it
Yeah.
was let me first spend my own money to see if this concept
Mhm.
actually works before I bring in a lot of investor money. So there were no, investors in the
Mhm.
Idaho Falls project. It was just me.
Awesome. Awesome. Yeah. I moved here right around the time. I mean, I think it was still a field when I moved here. I've been here since 2021. It's about 4 years now.
It was completed in 2021.
Yeah.
But you know what's really fascinating to me is that the other city that you mentioned, Provo, Utah, I'm very deeply tied to.
Yeah.
So the first time I did construction, so I don't just buy buildings,
Mhm.
like everybody else, like I buy a bunch of multifamily value adds, but I actually like to build buildings. And the
Mhm.
first building that I built was in 2003. It was a commercial campus for my tech business.
Yeah.
And that's where I learned how to build things, right? No investors, no bank, no lending. It was just all cash. But the first time I actually built an apartment complex
Mhm.
was 5 minutes from Provo, Utah in 2016
Okay.
in a small city called Springville. And the
Yeah. That's great.
building, 102 units, was called Art City Center. It's right next to the mountain.
Yep.
Literally, I mean, it's the last street before the mountain. So Art City Center still remains one of my favorite
Yeah.
builds. Back then I had a lot more time, so every little color, every little pick of every little surface was something that I got to do. Now, unfortunately, I have teams that do this, so I don't get to participate as much. But Art City Center, so if you just type in Art City Center Springville, that's the first project that I built. So it's interesting, Brian, that you were connected to
Hmm.
both of my first builds.
Yeah. That interesting. Yeah. My older brother lives in the next town down from Springville. And yeah, so I don't get to that part of Utah very frequently, but we've toured lots of apartments in Springville as well. I mean, it's kind of a small community, but there are several apartment listings in the last 2 years or so that were down in that area. So beautiful area, a lot of growth. And you mentioned, right by the mountain. It's hard to be in Springville and far from the mountain because it's just right up there. And it's amazing, pretty little town. So,
Let's talk about Provo for a minute. So by 2014, when I went public
mhm.
and became a syndicator and did a syndication for the first time, I started to think that I needed to hang my hat on a city every year.
Mhm.
So as it happens, for in 2015, the first time I wrote a 75 slide presentation. I love long, complex, data-driven presentations.
Mhm.
And that presentation was called Real Estate Trends 2015. That was the first time I picked a city in the US as my top pick. And
Yeah,
that city happened to be Provo, Utah.
interesting. Yeah.
So, being one of only two cities that has won my city of the year for real estate investment
Mhm.
twice back to back.
Yep.
So that only two cities have won. The first one is Provo, Utah. The second one is Raleigh, North Carolina. But most of the time, I try to actually find other cities than the ones I picked the previous year, simply because people would then accuse me of, pumping up the city that I was investing in. So I would always try and find a new city. Now I actually publish two cities. What
Mhm.
happens in that real estate trends presentation, which is in January, and it's our most popular presentation, about 2,000 people sign up for it. I go through about 75 cities and then
Okay.
I pick one as up and coming and one as best city in the US for investment. For
Hmm.
2025, this is done at the end of January because that's when all the data comes out from all the different providers for the previous year. The up and coming market was Vegas,
Okay.
and the best market in the US was Indianapolis.
Interesting. Yeah, Provo is an interesting little place. It's topped a lot of different charts, not just the real
Mhm,
estate investing ones. It's
mhm.
been like the U.S. News best city before and top anyway.
Yes. So of the various city ranking
Hmm.
methodologies, the one that I like the most that is very data science driven is done by an institute called Milken, Milken.
Yep.
Each year, Milken puts out a report. It's free. You don't have to pay for it. So if you just Google Milken Institute or tell ChatGPT to get you the reports for the
Yep.
last 10 years, you'll see some amazing information. And they've ranked Provo twice in the
Yes.
last 10 years. They've
Yeah.
ranked Idaho Falls twice, but as the
Mhm.
small city. They have a large city category and a small city category. The
Yep.
large city is over 250,000 people. The small city is under. Idaho Falls is won twice for small city. But
Yep.
what I'm really proud of is for both Provo and Idaho Falls,
Hmm.
they picked the cities 1 year after I picked them, right? I
Nice.
suppose it takes somebody like that who has to gather a lot of information. It takes them longer to get there because they're looking at more stuff. They have more people. So it
Yeah.
was nice that,
Yeah.
I already had purchased my land in Idaho Falls and had started construction when it was picked as number one city in the US by Milken.
Awesome. I like that report. It shows up in all of my investor decks. We're doing a lot in Davis County, like the
Hmm.
Milken calls it the Ogden Clearfield Metro. I think, statistically it's the Ogden Clearfield and then Salt Lake Metro. Those are the two metros where I have multifamily properties. And in 25, Milken had them two and three. So I don't
Uh-huh.
remember which one was two and which one was three, but you know,
Ogden is still staying at the top. There's also sometimes I see Logan, which is a little bit further
yep.
sort of northeast. So Logan comes up a lot. If I had some time, I'd go buy land in Logan and build something
Mhm.
there.
Logan's beautiful. It's up in the mountains. It's also on the small city side as well. But yeah, it's a
Even smaller than
beautiful.
Idaho Falls. Yep.
Yeah. I mean, from me in Idaho Falls driving back to Salt Lake, if I wanted to take the long scenic route, I'd go through Logan every time. Just a really, really pretty drive and pretty area. So, well, cool. Let's talk about, trends you're seeing right now. And you mentioned a term that you coined before we hit the record button. It was
Yeah,
the
the multifamily
multifamily
yield
yield curve.
curve.
Yeah. So let's talk about that a little bit. What is it and why is that important?
It's a riff. It's not really a yield curve. But
Mhm.
you know what? A lot of people, you've heard people say something like the yield curve is inverted. Therefore, there's a high chance of a recession in the next 18 months. So you've heard that, right? So I'm taking that concept of yield curve, I'm
Mhm.
stealing it and applying it to something that's really not a yield curve. So one of the things that you should know is that there's changes coming to multifamily whenever a class A price per door becomes less than a class B price per door. This has only happened once before. It happens in 2010 for a very short amount of time. So it's actually a very rare occurrence because, as you can imagine, Class A, right? These are brand new buildings. They're built in the last, 5, 10 years. Some of them are built in the last year, very fancy looking buildings.
Mhm.
And can you imagine a Class A building selling for a lower price than a Class B?
Mhm.
And so you might say,
Seen
how
it.
can this even happen? That just
Yeah.
doesn't make any sense, right?
Mhm.
Well, the answer is, and that's where the biggest opportunity lies today, is once the interest rates went up, banks changed the way that they did underwriting, especially Fannie Mae and Freddie Mac, who are the largest two lenders to multifamily.
Yeah.
And so here's what's happened. Let's say that I have a property that is a Class B and a Class A sitting next to each other.
Mhm.
They're right next to each other. They're both 95% occupied, so no difference there. And the Class A is built last year, and the Class B is built in 1990. Now, this
Mhm.
Class B obviously has lower rents than the Class A. So it has, let's call it 1,750 in rents for a two-bedroom. And then
Yeah.
the Class A, their rents are 2,000, right?
Mhm.
So their rents are about $250 per unit higher, which is normal. Now, here's the thing. Normally, what happens is because these rents are much higher, this property is going to sell for more, probably 10,
Mhm.
15% more, and that's pretty common. But today, what's happening is this property to stay occupied has been forced to do 2 months of concession because every other Class A property around it is at
Mhm.
2 months of concession. So there's a Class A recession going on right now, and
Yeah.
it's tied not to occupancy because their occupancy is really great. It's
Mhm.
tied to concessions. So
Right.
now, when this property at $2,000 a month in rents, it offers 2 months of concession. Well, that's a 16% reduction in rent,
Mhm.
8% for each month, roughly. So if you're giving 2 months for free, that's like a 16% discount. Well, if you take $2,000 and knock off 16%, well, now your effective rent is a little bit over $1,700.
Right.
And while before concessions were generally ignored by banks because they knew that the concessions would go away, that's not happening today, at least in today's marketplace. Q2 of 2025, the banks are not ignoring those concessions. So guess
Yeah.
what they're doing? They're pricing loans for Class A properties on the basis of the lower number, the
Hmm.
1700 number. So for now, the Class A property gets a smaller loan than the
Yeah.
Class B property, which doesn't have any concessions. And
Hmm.
as a result of that, something truly bizarre is happening. In the last 12 months, the average price per door for Class A properties in the US, remember some of them are 500,000 a door,
Hmm.
$1 million a door in New York and California. They are at 237,000 a door.
Hmm.
And Class B properties, which are, fully at market rent, were at 245,000 a door. That is a stunning number, right? And I don't think that'll ever be achieved again. So
Hmm.
for the moment, I tell people the best deal is unquestionably buying a Class A,
Hmm.
but, and here's a big but, it's a very, very large
Yeah.
but only buying it in a market where the last 12 months were a bloodbath. And by
Hmm.
bloodbath, I mean minimum 2 months of concessions, maybe even 2.5 or 3, like Austin or Huntsville, Alabama,
Yeah.
right? And the next 12 months, according to CoStar, has almost no delivery. So last 12 months, everybody and their mother were delivering. And the next 12 months, there's very little. If you can find a submarket like that, buying a Class A in that submarket today would beat the crap out of a value add strategy.
Yeah.
Absolutely beat the crap out of it.
Yeah.
Because you would
And
get you
yeah.
don't have to grow your rents. You just have to hold and you still get about a 10 to 15% pop in value by
Yeah.
just holding, doing nothing else but holding. That never happens,
Yeah.
right? I've never seen anything like it. It's
Mhm.
bizarre. And it's totally tied to the banks basically saying, no, we're just going to use your post concession net rent rather than using your gross rent.
Yeah, that's interesting. I'm thinking we've got a couple of properties, really close to downtown Salt Lake. I've got a couple of B-class properties. We're forced to give similar concessions, but I mean, the brand new
Yes.
A-class, we're averaging 6 to 8 weeks of concessions. And on a B-class at a lower rent point, we were getting away with about 4 weeks of concessions. So
That's a Salt Lake City thing. So,
that's Salt
so
Lake
off,
City. Yes.
Salt Lake is one of the top 5 markets in the U.S. that's affected by concessions.
Yep.
So Salt Lake is like Provo doesn't have as many concessions as Salt Lake does. It does, but it doesn't have as many as Salt Lake. So the fact that Bs are now offering concessions is also fairly common, but it's
Mhm.
not an across the board sort of thing,
No.
right? So
And
I would
yeah.
suggest you find a market where the Bs are not offering concessions and buy a Class A in that market, right? So it's basically a Class A recession and so
Mhm.
you're getting recessionary prices for Class A in that marketplace. But it doesn't work if there's a huge amount of supply in the next 12 months,
Right.
right? The strategy only works if the supply is ending. Now, as it happens, when I say supply is ending, I don't mean no supply. I mean the oversupply is ending, right? So the US builds in a normal year about 400,000 apartment units, right?
Mhm.
Last year we delivered 600,000,
Mhm.
right? So that's 50% over. There was a glut. And
Yep.
that meant that rent growth was basically nothing.
Mhm.
Also, another thing is that what's holding values down of Class A is that they've had no rent growth in the last 18 months. And
Yep.
so underwriting is very cautious. And that's why we're getting deals. So right now, what we are doing is we have $100 million fund with money in the bank. We send, we work only with banks. We don't work with sellers. We basically just tell banks, hey, if you have a property that's coming back, here's how much I would pay for it. In 100% of the cases, they say, no, this is less than our loan amount. And we basically say, well, here's our offer, 30-day close, all cash.
Mhm.
And our goal is to basically make 100 of these offers every year, and
Yeah.
3 or 4 properties will come out of that.
Mhm. Yeah, yeah, I like that. I like that strategy. Now, are you willing to share? I mean, I assume you've crunched the numbers already. Are you willing to share a couple of the metros that have those, high concessions last year and then dropping off that supply cliff in the next year?
I don't have any metros, but I have certain submarkets, right?
Okay.
So submarkets I do because what I'm finding is within metros there's too much diversity. So Buckhead in Atlanta had a
Hmm.
huge amount of supply in the last 12 months, and if you wait another 3 months, then the supply just drops off the cliff. And then
Yeah.
in Phoenix, Mesa is a market that drops off. But on the other side of Phoenix, Avondale is a market that doesn't drop off at all. So I wouldn't buy in Avondale, but I would buy in
Mhm.
Mesa, Arizona. So those are interesting markets to look at. If you're pulling a CoStar submarket report, I think it's page number 7 or 8. It
Hmm.
has a chart. And in those charts, if you see thin, tall blue lines, you know you're on the right chart. And what you're trying to do is on that chart is you're trying to find a chart
Hmm.
out of all the submarkets in your preferred market, call it Salt Lake. Salt Lake has like 9 or 10
Yeah.
submarkets, right? All the way down, like halfway down to Provo is still Salt Lake submarkets. So you're trying to find a submarket where there's very, very tall blue bars on the left side of the graph,
Hmm.
but there's a vertical dotted line that shows today,
Today,
right?
yeah.
And then beyond that, you want a submarket which has very few tall blue lines. It can have some small ones,
And
but
that's
very
that's your
few tall ones. So
deliveries
this
graph.
exercise is really just tied to this one page.
Hmm. Okay. Interesting. Something I'm interested to hear. There's different philosophies on multifamily investing. The way I build my business is I've picked a metro, and I'm not going outside that metro. You go to where the data leads you. Can you,
Yes,
can you talk about why you like that? And then something else, I think kind of a pros and cons approach. Is there a downside to doing that? Is it more difficult? What is there an extra barrier to entry of going that direction?
I hate it. I don't like it at all. I don't want to do it. I don't
Hmm.
ever want to do it. But it's tied to my philosophy of I have to do what the data tells me, right? So I try to behave as much of a robot and as little of a human when it comes to my investing decisions as possible. And so my investing decisions tell me that there is no great city for investment. There's only decent cities for investments over a 10-year time frame.
Hmm.
The only way to get from decent to good and from good to great is to switch cities every couple of years,
Hmm.
right? The other thing that I've found is no matter how good a city it is, Austin's a perfect example, it gets saturated. So eventually everybody knows that it's a great city and it
Hmm.
always gets overbuilt. So like Austin this year is delivering 5,000 units beyond its absorption rate. Last year it delivered 8,000 units beyond its absorption rate. So it had the highest rent drops in a city, over the last 5 years. So rents dropped, depending upon which submarket you're talking about, between 10 and 20% in Austin. And this
Yeah.
is the same city that was considered to be the best in the US 5 years ago. So it's a perfect example. You could pick Nashville, same
Mhm.
examples would apply. You could pick Dallas. Dallas has negative rent growth right now. You could, and these are great cities. There's nothing wrong fundamentally with Austin or Dallas or Nashville. These are great cities, great population growth, great job growth, but negative rent growth,
Mhm.
right? And this is happening when the US has positive rent growth. And there's markets in the US, especially in the Midwest and Northeast, that have 3+% rent growth, right? So we're not seeing a across the board recession in rent growth, but we are seeing it in these big markets. So the reason why I chase markets is because my data tells me is that markets go through cycles, and I try to be in a market in the early part of the cycle, build something, sell something, get out, repeat.
Mhm.
The part that I hate is exactly the one you hit the nail on the head, Brian. It is 3 times the work. It's very painful. Just as you're getting really, really good at knowing all the lenders, all the builders, all the developers, you have to leave.
Yeah.
So from building a business perspective, it's 3x the work,
Mhm.
but it significantly juices the returns. You can see the returns on my website. So it's a lot of work. And I think that I would not have been able to do it at all if I didn't build an army in the Philippines, because that's just
Mm.
a catastrophic amount of work. What I did was I built a business in the Philippines fully owned by me
Okay.
that has 20 plus employees. They have their own directors, their own recruiters, their own managers, supervisors. They're a service business and they provide services to us. As it happens,
Mhm.
I just own the whole thing. And because they provide about 40,000 hours a year of work, so
Mhm.
everyone's full time, so 20 people, 2,000 hours, 40,000 hours, that allows me to make those jumps from metro to metro without pulling my hair out.
Okay. All right. So yeah, you've got a lot of it automated, a lot of delegation going on, and army. I like that word. An army of people in the Philippines running stuff. So.
A lot of software as well. We use 137 web software. They're all
Mhm.
connected using a single software called Zapier. If you don't know what
Mhm.
that
Yep.
is, check that out. And so, but the newest one, which really has been so powerful in the last year, is the use of custom chat GPT strings. So,
Mhm.
chat GPT by itself is meh. It's not very good at what it does. But
Mhm.
what you can do is you can create a master account for your company, or each department can have their own master account.
Mhm.
And within that account, you can create a project, and that inside of the project you can give it custom instructions. Now
Mhm.
inside of the project you can have then a string which is for one specific purpose, and you give it lots of instructions. And the way that we do it is that we go into a Zoom room, we brainstorm on an idea for 10 or 15 minutes, maybe 30 minutes, and we say, this is the right way to do this. These are all the things we should know. This is what should be done in Excel. This is what should be done, in terms of structuring, blah, blah, blah. 30 minutes, just pure brainstorming. During that time, there is a dictation software called Fathom AI that is listening. When the meeting completes, we go and grab the Fathom transcript. Fathom's not as powerful as ChatGPT. We grab the transcript and we throw it into a custom string of ChatGPT. And then that 30-minute transcript is the instruction for ChatGPT for that string. And then after that, let's say we have to throw a CoStar report in there. You just throw the report in there, do nothing else. You just throw the submarket report, and it gives you a 10-page output of everything according to things that you believe in. Like what's more important, what's less important, what's the input, what are the tables, what are the rows, what are the columns, what do I want, what are the things I want to compare. That's much more powerful than a CoStar report, because a CoStar report is just a generic report written for 1 million companies, not for yours. But imagine turning a CoStar report into a 20-page report that's specific to all the things that you care about, because you gave it 30 minutes of custom instruction. We now have hundreds of ChatGPT customized strings in every department of the company. For example, everyone sends out investor updates. Most people do them 4 times a year. These investor updates are pretty long. They tell you a lot about the property. What if you had a string for every project in your company that was a ChatGPT string, where when you started the project, you did this fancy PowerPoint deck and you also did this underwriting? What if you threw the underwriting and the PowerPoint deck in there so it already had a good basis? And then every time you did an update, you put a link to that update into ChatGPT and told it to suck all that information out. Now ChatGPT becomes the person that knows the most about this property, bar none. ChatGPT knows that string knows more about the property than my asset manager. And she's doing it 8 hours a day. Why? Because she doesn't have the ability to remember things from 3 months, 6 months, 9 months, 12 months ago. It has the ability to remember an entire book about that project. So as you can imagine, when questions come in, we no longer attempt to write answers. We have ChatGPT write the answers and then have humans read the answers and correct. Can you imagine how much time that saves?
Yeah, a ridiculous amount of time, and I dabbled with ChatGPT, and it's definitely a time saver. But yeah, I'm taking notes over here, But I'll run this through my AI later and throw it into ChatGPT and see what it comes up with. But that's one thing that we haven't done a whole lot with yet, is like the ChatGPT. Yeah, it's something that's been on the back of my mind for a long time. We need to figure out how to leverage it a little better than we do. But interesting, very, very interesting. Yeah, I appreciate your comments. I mean, I have a small coaching program, and I actually use you as an example quite a bit because you do chase the hottest markets. And glad to hear you say that. I was actually really pleased, just to hear you say that you hate what you do. But the numbers, yeah, you're chasing the numbers, you get the better returns, and it's 3 times harder is what I get out of that. But you've been basically able to leverage your Philippine Army ChatGPT to make it manageable, in essence. So
yeah, there's a lot of technology pieces required to jump markets. I would not recommend this as a typical strategy. Maybe jump a market every 3 years and maybe deal with 2 markets at a time. We deal with 10, and it is hard for us, even with our army and with turbo boosted ChatGPT.
Yeah. Okay. Awesome. Well, hey, thanks for sharing that. Very much appreciate it. What do you see on the future for you, your business, and what direction you're going to be going?
The direction that we are going is away from retail investors. So we have not done a retail raise now with retail investors since May of last year. And I don't think we're going to do one for the next 2 to 3 years. So once you get to a certain level, we've had 9 exits over 6 years. The goal is to go after institutional money, family offices. I like family offices more than institutional, to be honest. Just in Q1, we received $100 million for projects from a family office that's non-US based. And we find that allows us to be a better company, because what we can do is we can tell them, we're going to build 10 projects. They're all going to be identical. They're going to use the same architectural design. They're going to be using the same style, basically a widget. So we built 22 townhome widgets, and we applied them based on whichever one makes the most sense for a certain market. Now I can build townhomes at an extremely low cost, at a very, very, very low cost. I'm also self-performing. What that means is I'm not just a developer, I'm also the builder,
Hmm.
right? So by doing that, I'm able to get tremendous scale and get very consistent performance. And
Yeah.
that's just not something that I can do with value add. I mean, when I'm buying value add in one market, my results are so different
Hmm.
from another market or another sub-market. And so I've been focused on consistency of
Hmm.
returns. And I'm finding that I can do it with development, even with these tariffs and things like that. With tariffs, I mean, bottom line is you just add about 7 or 8% to your construction cost. Yes, it makes it harder for projects to pencil, but still enough of them pencil, especially because I'm self-performing. So my construction costs already are 15, 16% lower than everybody else's.
Yeah. Okay. Yeah, and I appreciate that as well. I mean, it's retail versus the institutional family offices. Now, you mentioned something that you liked family offices more than institutions. Is there a specific reason why?
I'm going to get in trouble for saying this, but family offices are more emotional in their investment.
Hmm.
Institutionals are more data driven. And
Hmm.
so, ironically, for somebody data driven like me, I still want a emotional investor
Hmm.
rather than an institutional one. So I want everyone inside of my company to be data driven. But
Hmm.
certainly, if I can get equity that is emotional, that actually helps me and makes it easier to raise money.
Okay. Yeah, it's interesting. I've heard this and I believe it. People always make emotional decisions and they use logic to justify it.
I
I
found that to be true 99% of the time, that people, the decision is definitely an emotional one, but they're like, I will pick on this logic piece or this logic piece or this logic piece and make myself, think that I'm being logical. Now,
yeah.
institutions who are well aware of this,
Hmm.
especially the large ones, what they do is they have put safeguards at every step of the process to prevent those decisions from being illogical. So basically, there's like 60 metrics that a project has to hit. And if it doesn't hit, 50, 55 of them, it can't even be presented to a committee.
Mm.
Well, that makes it hard to use in motion.
Yeah, I agree. And I mean, it's something that I've been looking at, just kind of like how I make decisions, and interesting. I like that. Family offices are still emotional. So, well, cool.
Don't tell them that.
Well, yeah, nobody wants to hear that, especially the people that pride themselves on being logical. And for many years, I prided myself on, making logical decisions. And when I first heard that phrase, I dismissed it. And then later on, I think I did a little bit of self-examination. It's like, oh my gosh, that's actually true. That's exactly how I do things. But yeah, interesting to hear that on like family office and institutional levels. That's how they make decisions. We're about at the point where we need to start wrapping up. So, one question that I like to ask everybody, if you're giving advice to somebody who is just starting out in multifamily, so I guess rewind to yourself in 2014, what would that advice be?
Buy as much Bitcoin as you can. I know it's not multifamily.
Yeah.
I think that obviously,
Hmm.
if I could give advice to somebody in
Yeah.
2014, I'd say buy as much multifamily as you can, given the
Right.
extraordinary events that followed over 8 years,
Hmm.
and sell everything in 2022. But I think that would be cheating. What I would simply say is that the United States is now becoming like any other European economy,
Hmm.
where homeownership rates are falling
Hmm.
and are continuing to fall year over year over year. So today in 2025, the median home requires an income of 116,000 to qualify for a loan, whereas the median income is 75,000. So there's a
Hmm.
$41,000 gap between buying a starter home and being able to buy a starter home.
Yeah.
And that means that 52 million American families can no longer afford to buy homes.
Right.
So the US is becoming renter nation.
Hmm.
This doesn't mean that multifamily is going to be as profitable in the next 10 years as it was in the last 10 years. The last 10 years was an extraordinary one-time event. It happened, but I think it will be a profitable and growing business as more and more people become renters. You're
Yeah.
going to see people with much higher incomes become renters than they did before. And I think that is something that is extremely important for people to understand. There was an acceleration after COVID. Home prices are up about 50% since COVID. So it's been 5 years. So in 5 years, we've seen a 50% increase in home price. We've seen a doubling of the mortgage because interest rates have also doubled.
Yeah.
So if there's a 113% increase in the mortgage, but
Hmm.
only a 22% increase in incomes, what do you think will happen?
Yeah.
More renters.
Yeah, absolutely, absolutely. That's a trend. And I see a lot of government officials that are trying to kind of reverse the trend. And honestly, I don't know if I see it reversing. I think there's sub-trends that are similar, like people are putting off marriage, longer and longer and longer, and people are putting off
Yep.
having kids longer and longer and longer. And if you look at like the stereotypical American, family from the 50s, they would buy that home as early as possible. And I think the same things that are driving, marriages to be delayed and kids to be delayed are also delaying that first home purchase as well. So I think it's a larger societal trend than just, homes have gotten more expensive and interest rates have gone up. But that's me speaking off the cuff right there. I haven't,
I think
that's
you've
zero
you've hit it on
analysis.
the head that
Yeah.
some of that is happening simply because people are not able to buy homes. So there's reasons why people are choosing to get married later.
Yeah.
So it's harder to settle down. It's harder to achieve the American dream. That doesn't mean that we're going to become a depressed nation. We're still one of the happier nations in the world. We'll still get lots of great things done in this country. But there was a time where it was easier to become a homeowner, and that time has passed.
Okay. Got it. Got it. Awesome. Well, last question for you, and that is, how can listeners learn more about you?
We gather an incredible amount of data, but data
Mhm.
is not useful. What is useful are stories, interesting ideas, and concepts that create aha moments. So we create 8 bespoke presentations. These are about 60 slides each, and they're
Mhm.
all designed to create aha moments with the use of data. And we stick them for free on multifamilyu.com. That's multifamily followed by the letter u.com. Last year, 11,000 data-driven investors came to our website, watched our
Mhm.
presentations, didn't pay for a thing. We do not have an educational program. We have no intention of ever creating an educational program that's a paid program. We think of ourselves as the Wikipedia
Mhm.
of commercial real estate education. So come and enjoy. Of those 11,000 people, only 1,000 are our investors. The
Mhm.
rest, they're just getting stuff for free, and we don't mind giving it out at all.
Awesome. So multifamilyu.com, we'll put that in the show notes for everybody. I also promise to put the real estate trends in the show
Yes,
notes, but I Googled that while we were talking, and guess where it's at? Multifamilyu.com.
multifamilyu.com.
Perfect.
Yep, it's right there. It's hard to miss because
Okay.
it's just been presented.
Yep. Awesome. Well, Neal, thanks for coming on the show today. Very much appreciate your time.
Thanks for having me on.